Okay, welcome to clip 3, and we're going to talk about the other major type of market setup, the over-the-counter market. The over-the-counter market. It is a geographically dispersed network of broker-dealers, so it's not one physical location. It is a geographically dispersed network. It's an electronic network of broker-dealers. And these broker-dealers make markets or hold inventories. They have their own inventories of securities. Okay? It was started in 1971 by a group of broker-dealers, brokerage firms, that wanted to make it easier for companies to go public and to raise capital. So they have less stringent financial requirements. They wanted to compete with the New York Stock Exchange, and they wanted to make it easier for smaller companies to go public and to raise capital. Orders are presented to market makers, these dealers, rather than matching up buyers and sellers like exchanges do. So the way the orders are transacted is different than how it's done on an exchange. It does include some listed and some unlisted securities, and listed means a stock trades on an exchange. So some stocks that trade on an exchange will also be traded over the counter. It is the largest secondary market in terms of the number of issues that trade. 15,000 issues in total roughly trade over the counter, as opposed to, I think it's 10,000 or so roughly that trade on the exchange, on exchanges. It is also the largest in terms of the volume, about the average daily volume, about 5 billion shares a day trade versus about 4 billion shares a day trading on exchanges. So the over-the-counter market, a very large market organization. All right, as I mentioned, it imposes less stringent requirements on its companies, so there are a lot of smaller companies that trade. A lot of large companies currently trade over the counter, but they were small when they started, when they were first listed, or when they first began trading publicly. Companies like Google and Microsoft went to the over-the-counter markets instead of the exchange markets. Okay? Please note that all government and municipal bonds and most corporate bonds are traded over the counter. The over-the-counter is a negotiated market. So to be traded, a stock must have at least 2 competing market makers or dealers. Any number of dealers can make a market in a stock. There's not any limit as to how many dealers want to make a market in a stock. And so there was an average of 15 market makers per stock. So every stock that trades over the counter had an average of about 15 dealers that actually held inventory and made orders happen for their clients. All right, so there are 2 main over-the-counter market operators. Just like ICE is a major market operator for exchanges, there are 2 major market operators for the over-the-counter type of market, and the first is NASDAQ OMX. Okay, stock symbol is NADQ. NASDAQ stands for National Association of Security Dealers Automated Quotations. Okay, it's an acronym. In 2008, the NASDAQ merged with OMX to increase its global footprint. So 2 over-the-counter market operators merged. It's a business that has publicly traded stock, and these 2 companies merged to create a bigger operator of over-the-counter markets. And they have more than 3,500 stocks trading on their markets from 35 countries. Market value of the stocks about $7 trillion. Okay? It is an electronic network that makes dealer quotes electronically available and on 3 different levels. Okay? Level 1, these are the different levels for the NASDAQ market. Level 1 is a free level for all casual customers to see what the broker-dealers are bidding and asking. Level 2 is for serious traders, and basically serious traders could see all of the quotes being made by all of the market makers in a stock. And then level 3 is for dealers who want to be market makers, and they can enter their own quotes. So 3 different levels of trading. All right, the second primary operator of over-the-counter markets is the OTC Markets Group, stock symbol OTCM. So it is another company, it's publicly traded, that is in the business of facilitating trade. Okay? It is actually larger than the NASDAQ in terms of the number of securities traded. 10,000 securities trade here. Market cap of the securities traded, 10 trillion versus 7 trillion on the NASDAQ. All right. They have at least 3 different market levels. The first one's called OTCQX, and this is where larger companies that report to the SEC and that meet certain financial requirements are traded. Then you have OTCQB, and these are earlier stage companies that still meet financial requirements and that report to the SEC. They trade here, but they are riskier, younger companies. And then you have OTC Pink, and this is where speculative and troubled company stocks trade. Okay, a lot of penny stocks, stocks that trade for 10 cents and 12 cents and 15 cents, trade OTC Pink. All right, let's take a quick look at security pricing. We covered this in managerial finance, but I want to revisit this topic now. So first note that every security has 2 prices, not one price. The one price that you see on a quote is often the last price that was traded, but at which a stock was traded. But every security has 2 prices: a bid and an ask. Now the bid is the lower of the 2 prices, and if you own a security and you want to sell that security, then you will receive the bid. Then there's the ask, and the ask is the higher of the 2 prices. If you do not own a security but you want to buy it, you will pay the ask, which is the higher of the 2 prices. Okay? Please note that market makers, dealers, trade on a net basis. In other words, they do not charge a commission for a trade. Rather, their profit on a trade is the spread between the bid and the ask. Non-market makers and exchanges, in other words, a brokerage firm that doesn't make a market in a stock but gets a transaction done, and exchanges, all exchanges, charge a commission. So there's a difference between being an over-the-counter market maker where you earn the spread, and being a non-market maker or an exchange and charging a commission. Okay? Dealers do change their bids and asks depending on their inventory, depending on supply and demand for the stock. And if they want their inventory to go up, then they'll increase their prices that they're offering out there to buy stocks. Okay? And they will also change their prices based on the outlook they have for the stocks. Remember that dealers buy the stock and own the stock. So if they own 10,000 shares of a stock and they think that the stock price is going to go up, they might want to buy another couple of thousand shares, because if the stock price goes up, then they have made money. So dealers hold an inventory for their own speculative or investment purposes, but they also hold an inventory for their clients to sell and to buy for their clients. All right, then there's this thing called the third market, all right? And this is where over-the-counter trading happens for listed securities. So if there's a problem on an exchange, sometimes dealers will make contact with each other and they'll trade over the counter. They'll trade a listed stock over the counter. Okay. A lot of times, large institutional investors like pension funds will go to the over-the-counter market to try to work out a trade. They'll go to their dealers and ask their dealers to put the word out on the street that they want to buy or sell, and it works better on the over-the-counter market to do it that way than on an exchange, because remember, on an exchange they have to find buyers and sellers to match up, whereas you can put the word out on the over-the-counter market and see if you can get people to buy or sell. All right, and then you have the fourth market, and the fourth market is direct trading of securities with no broker or dealer in the middle. And it's done by large institutions to save on commissions. So a pension fund A may own Microsoft and may want to sell part of their ownership of Microsoft, and they may call pension fund B and say, hey, we noticed that you just initiated a small position in Microsoft. How would you like to buy 10,000 shares of Microsoft? And we'll cut the middleman out, and I'll get a higher price for my stock, and you'll pay a lower price for your stock than if we had done it on the market. And so that is called the fourth market, or direct trading. And just to let you know what commissions look like, the average commission for large trades used to be about 1% of the value of the trade, okay? And so you multiply 0.01 times the number of shares times the price per share, and that could add up to a lot of money. And today, commissions have dropped on large trades to about 1/10 of 1%. So again, the markets have really evolved and developed over the years. When I first got into the market, we'd see 300 or 400 million shares traded in a day. Now we see 3 or 4 billion shares traded on the exchange, and 4 or 5 billion shares traded over the counter. And commissions used to be between 1% and 2%, and now they're between 1/10 of a percent and say 1/4 of a percent for smaller trades. So the marketplaces have gotten much, much larger, much more efficient, and prices or commissions have really come down. Okay, so that's it for this clip, and we'll move on to the next clip. Until then, shalom.